Hey, in today's video, we're talking about charitable giving, and is there a way for you to get a double tax benefit from your charitable giving? That's what we're going to talk about next. Hey, this is Mel Stubbs. I'm a financial planner with Christy Capital Management, where we're helping federal employees plan for a better retirement. If you need help, go to christycapital.com, click Talk to an Advisor. Now, more and more people that we're talking to, when we ask them, about what's the purpose of your money, we're finding out that some of the people, they want to use some of the money they've saved for charitable giving. Now, there are different ways that you can be charitable with your money, and the government treats it differently tax-wise. You can just write a check and give to charity, but you only get to write it off if you itemize your deductions on your tax return. In 2024, the standard deduction for a single filer is $14,600. For married filing jointly, it's $29,200. And so when you try to itemize your taxes, your deductions for your tax return, let's say you give $10,000 to your church. Let's say you have $5,000 of mortgage interest. Maybe you have very few other deductions, and so they don't add up to more than the standard deduction. In that case, it's more advantageous to use the standard deduction, which means in essence, you're not really getting to write off your charitable giving. Now, one of the best ways that you can use the standard deduction and get the write-off for your charitable giving is if you do a qualified charitable distribution, or a QCD. Now, you have to be 70 and a half years old or over to do this, and you can give the gift directly from your IRA to charity of your choosing. Now, you'll get a 1099 at the end of the year showing the taxable distribution that you took, and you will need to match up, the statement from the charity to prove that you gave it directly to the charity. Whoever your custodian is, let's say Fidelity, for instance. Fidelity doesn't know that it was a charitable gift, so they send out the 1099 as if it's taxable, and it's your responsibility to give the correct paperwork to your tax preparer to make sure that you don't pay taxes on it. But with the qualified charitable distribution, you can take the standard deduction and you can give the money directly to your charity from the IRA up to $100,000 a year, and thereby claim both benefits of the standard deduction benefit and the charitable gift as well. But there's another way that you can give money away and potentially get extra tax benefit for doing it, and that's using a donor advised fund. So here's how this works. You have a donor, which would be you. You can set up a donor advised fund and give your gift there. For instance, let's say you gave $100,000 to a donor advised fund. You are able to take the income tax deduction in the year that the gift happened. Once it's in the donor advised fund, you have the choice to distribute it to a charity whenever you want to. It does not have to get distributed in the same year. In fact, many people like this option because they can decide, how you want the money to be allocated and invested inside the donor advised fund so that it can grow. Each year, as you have charities that you want to support, you can distribute to the charity whenever you want. If the account grows enough, it will allow more gifting to charity over time. Keep in mind, though, that the tax deduction happens when you make the gift. So with the donor advised fund, the gift can be cash or it could be non-cash assets, either one. Now, there are no limits to the amount of gifts that you can give. Now, we'll talk in a minute about some of the limits with the tax deductibility of the gift. But the first thing is the gifts are irrevocable, meaning it must go to a public 501c3 and it cannot be taken back once gifted. The account that you set up has to be titled as a donor advised fund. Now, let's talk about the tax deductibility of the gift because there are some limits. If you do a cash gift, you can do up to 60% of your adjusted gross income. So that means if your adjusted gross income is $100,000, you could only give away $60,000 or less and have it be deductible. If you choose to give away a non-cash asset, it can be up to 30% of your adjusted gross income. Now, there are some carry forward allowances, so gifts can be carried forward for up to 5 years. So let's go back to our previous example of someone having $100,000 of adjusted gross income and they give $100,000 of a cash gift. They can only write off 60% of the gift in the first year, that's $60,000. The following year, they could use the rest of it with the carry forward until they've used it all up. Now, you only have 5 years to use up the carry forward amount. And to get this deduction, you must itemize your deductions on your taxes. So the deductions need to be higher than the standard deductions. Now, with this feature, you may need to do some planned batching of your gifts. Since the standard deduction right now is $29,200 for a couple, depending on the size of the gift you want to make, It may mean that you don't give to charity for several years in a row, and then you batch the gifts together and then do one large amount into a donor advised fund so that you can take the itemized deductions. Now with giving cash, that seems to be pretty understandable how you do that. You write a check, you send it to the donor advised fund to fund the account. But if you want to talk about an additional potential tax benefit, let's talk about gifting highly appreciated assets. Let's say, for example, that you have $100,000 of highly appreciated Amazon stock that you bought way back in the day for $10,000. So the market value is $100,000, your cost basis is $10,000. If you sold the position and realized the gain, you would owe $16,920 in a tax liability. That's the $90,000 profit times 18.8% for long-term capital gains, saying that you owe around $17,000 in taxes. If you gift the stock to the donor advised fund, you can give the full $100,000 and you would not owe the $17,000 of tax that you otherwise would have owed. That's tax benefit number one. The other great thing is that the gift to the donor advised fund of $100,000 means you get to take a $100,000 deduction on the current year's tax return. Let's say that you were going to be in the 24% tax bracket and you lower your taxable income by $100,000. And therefore, you're not paying taxes on $100,000 of your other income at a 24% rate. So that's $24,000 in taxes saved. So you eliminated around $17,000 of taxes that you should have paid, and you lowered your current income tax due amount by $24,000 to get a double benefit. So let's compare the two gifting strategies. We've discussed one is a donor advised fund, and the other is using qualified charitable distributions. For a donor advised fund, you're going to need to itemize your tax deductions to gain a benefit. You can gift highly appreciated assets that can get a double benefit. Now, the limits for the deductibility are tied to your adjusted gross income, which may be lower for some people in retirement, but you do have the 5 years of carry forward to be able to stretch it out. Now, when we look at qualified charitable distributions, the first restraint is that you have to be 70 and a half years old to do this. Now, one of the benefits is that the gifts are above the line deductions, which means there's no need to itemize. You can still use the standard deduction and use this deduction. Now, there's a $100,000 per person limit per year on those gifts, and they have to come directly from a traditional IRA. So you could not give highly appreciated assets when using qualified charitable distributions. So for simplicity's sake, the qualified charitable distribution is probably easier, but there are benefits with using the donor advised funds as well. Now, many of the people that we talk to are very interested in tax planning, so there are some strategies around gifting money and the most tax efficient ways of doing it. If you need help with this type of stuff, go to christycapital.com and click Talk to an Advisor. If you want to watch another video about saving money on taxes, check out this one right here. Can you save $1 million with good tax planning? Reach out to us if you need help. My name's Mel Stubbs. Always good to see you.